Hey, everybody, welcome to the show. Today we're diving headfirst into the exciting world of market-neutral options strategies. These bad boys are your ticket to navigating the market like a pro, no matter which way the wind is blowing. Now, you might be thinking, market neutral? What in the world does that even mean? Well, my friends, it's simpler than you think. Market-neutral options strategies are designed to help you make money whether the market goes up, down, or sideways. That's right, you heard me correctly. These strategies don't rely on predicting the direction of the market. Instead, they focus on volatility, time decay, and other factors that can affect option prices. So if you're tired of getting whipsawed by the market's unpredictable swings, then buckle up because we're about to unlock the secrets to consistent profits with market-neutral options trading. Alright, let's kick things off with a classic market-neutral strategy, the long straddle. Now imagine this. You've got a stock you're watching like a hawk, and you have a hunch it's about to make a big move, but you're not sure which way. That's where the long straddle comes in. To execute this strategy, you're going to buy both a call option and a put option, with the same strike price and expiration date. Think of it as covering all your bases. If the stock skyrockets, your call option will print money. On the flip side, if it plummets, your put option will be there to save the day. The beauty of the long straddle is that the potential profit is unlimited, while your risk is limited to the premium you paid for the options. Just remember, this strategy works best in a volatile market where big price swings are expected. Next up, we've got the long strangle, a close cousin of the long straddle. Like the straddle, the strangle involves buying both a call and a put option with the same expiration date. However, there's a twist. With the strangle, you'll be buying options with different strike prices, both of which are out of the money. Now you might be wondering, why on earth would I want to do that? Well, my friends, the beauty of the long strangle lies in its cost-effectiveness. Since you're buying out of the money options, the premiums you'll pay will be lower compared to the long straddle. However, there's a trade-off. The long strangle requires a larger price move in the underlying asset to become profitable. So if you're expecting a wild ride in the market, but don't want to break the bank on premiums, the long strangle might just be your ticket to options trading glory. Now let's talk about the iron condor, a strategy that's all about embracing range-bound markets. This bad boy is for those of you who believe that a certain stock or index will stay within a specific price range for a set period of time. To set up an iron condor, you'll be selling an out-of-the-money call option and an out-of-the-money put option with the same expiration date, but different strike prices. To protect yourself from potential losses, you'll also be buying further out-of-the-money call and put options, effectively creating a condor with your options positions. The goal here is to profit from time decay as the options approach their expiration date. As long as the underlying asset stays within the range you've defined with your options, you'll keep the premium you received from selling the options. Just remember, this strategy has limited profit potential and requires careful monitoring. Next up, we have the butterfly spread, a strategy that's perfect for those who believe the market will remain relatively calm. This bad boy involves a bit more finesse, as you'll be buying and selling multiple options at different strike prices, but with the same expiration date. Here's how it works. You'll start by buying one call option at a lower strike price, then sell two call options at a middle strike price, and finally buy one more call option at a higher strike price. This creates a butterfly shape when you look at the payoff diagram. The butterfly spread is a neutral strategy that profits the most when the underlying asset experiences minimal price movement. Your maximum profit is achieved if the asset closes at the middle strike price at expiration. However, your potential losses are limited to the net premium paid for the options. Finally, let's talk about the calendar spread, a strategy that takes advantage of time decay and volatility differences between options contracts. This one's for the patient traders who understand that time is money in the options game. To execute a calendar spread, you'll buy a longer dated option and sell a shorter dated option with the same strike price. The idea here is to capitalize on the faster time decay of the shorter dated option compared to the longer dated one. This strategy works best when you anticipate a decrease in volatility or expect the underlying asset to remain range-bound in the short term. If your prediction is correct, the shorter dated option will lose value faster, allowing you to buy it back at a lower price and lock in a profit. There you have it, folks. A crash course on market-neutral options strategies. These powerful tools can help you navigate the market like a seasoned pro, regardless of whether it's going up, down, or sideways. Remember, these strategies are all about managing risk, taking advantage of volatility, and understanding the Greeks. However, it's crucial to remember that options trading involves inherent risks. Before you jump in headfirst, it's essential to do your homework, understand the intricacies of each strategy, and practice with paper trading before risking your hard-earned capital. Options trading can be a fantastic way to diversify your portfolio and potentially enhance your returns. But remember, knowledge is power. So keep learning, stay informed, and never stop exploring the exciting world of options trading.